Rare earth metals determine the next generation of technologies, from electric vehicles and wind turbines to advanced defense systems. Today, a fresh wave of headlines highlights price swings, policy shifts, and new mine approvals that could reshape global supply chains. The market watches the United States, Europe, and China as they compete for secure access to magnets and catalysts. Buyers rush to lock in material, miners expand capacity, and manufacturers recalibrate inventories. Rare earths have moved from a niche topic to a central risk in corporate strategy and security planning. This moment matters for investors seeking durable industrial leverage today. Rare earth elements are a family of metals, not actually rare, but often hard to access. They include neodymium, europium, and dysprosium, essential for permanent magnets, especially in EV motors and wind turbine generators. Global trade concentrates in a few mines and refining hubs, meaning a disruption in one country can ripple across electronics, aviation, and national security. Prices move on mine announcements, export restrictions, and exchange inventories rather than single data points. As producers expand capacity, buyers test long-term contracts and spot markets. Understanding the supply chain helps explain price volatility and why governments plan strategic reserves today. The modern rare earth story begins with early mining in the United States and China dominating processing by the 2000s. Political moves and labor costs reshaped markets as China leveraged export controls to become the arbiter of refining capacity. Western and Japanese companies built projects in Australia and Southeast Asia, but greenfield development faced environmental scrutiny and long permitting times. Those frictions created a structural gap between demand growth and supply expansion. Today, the world still depends on a handful of supply chains that couple mining, separation, and alloying into a complex chain where a single bottleneck can stall production lines today. Prices for several rare earths have recently surged on news of new mines, processing upgrades, and demand from electric grids and automakers. Investors have rotated into miners and refining developers, while traders watch stockpiles and port storage data for hints of spare capacity. Equipment makers and magnet producers report tighter margins as input costs rise. Central banks and policymakers signal more aggressive investment in domestic supply chains, adding to risk premiums. Banks initiate project finance reviews while hedgers rebalance risk by lengthening forward curves. In short, the market now prices not just metals, but policy reliability and geopolitical resilience today. Automakers relying on high-performance magnets, turbine manufacturers, and defense contractors are directly exposed to supply gaps and higher input costs. Major producers like Lynas and MP Materials, plus Chinese refining peers, anchor the supply chain, while new Australian projects aim to diversify sources. Investors include asset managers, sovereign wealth funds, and retail traders seeking exposure through commodity products and ETFs. Logistics and port operators face congestion as shipments reallocate and storage gains momentum. End users must rethink warranties, pricing, and product specifications as contract terms tighten. Policymakers monitor price spikes to gauge subsidies, stockpiling, and strategic reserves. Small miners chase off-take agreements and permits. Geopolitics shapes scarcity as major consumers raise import protections and strategic rivalries intensify. The US and EU push for domestic refining, rivaling China's dominance in processing hubs. Inflationary pressures, commodity budgets, and currency fluctuations influence project economics. A stronger dollar can curb financing appetite for long lead projects, while a weaker yuan improves export competitiveness for Chinese refiners. Climate mandates drive demand in clean energy, but environmental rules raise development costs. Trade agreements, sanctions risks, and freight costs add layers of complexity. Investors gauge scenarios where magnets, catalysts, and rarer elements become bargaining chips in geopolitical negotiation around the world. Smart money has tilted toward integrated miners and refining developers with clear long-term pipelines. ETFs focused on rare earths have seen inflows as macro risk intensifies and inventories tighten. Banks run project finance stress tests, while private equity explores off-take agreements and development loans. Sovereign funds in Asia and Europe diversify, seeking risk-adjusted returns rather than near-term volatility. Analysts emphasize the need for political risk insurance, diversified supply, and storage efficiency. Retail traders watch volatility, but many newcomers approach this space through themed funds rather than direct mining equities. Mergers and strategic alliances shape dialogue around price collars. Bear case includes a dramatic shift in demand, a sudden policy reversal, or new mining breakthroughs in a friendly jurisdiction that floods markets. If decisive refining capacity comes online faster than magnets are adopted, prices could correct sharply. Environmental hurdles and strict permitting may block planned projects, leaving chronic shortages. A currency shock could deter project finance, while extreme geopolitical tensions disrupt shipping lanes and create insurance spikes. Innovations such as substitute materials or recycled magnets could erode long-term pricing power. Finally, a sudden drop in EV demand or a global recession would test resilience more than any other scenario. Retail investors can approach rare earths with discipline rather than speculation. Start with broad exposure via diversified commodity or thematic funds to limit single project risk. If digging in, examine management teams with clear supply contracts and look for lenders comfortable with long-term offshore risk. Monitor government policy, subsidies, and critical mineral strategies, especially near-term procurement plans. Use risk controls such as stop loss on positions and position sizing to avoid concentration. Consider climate and ESG signals, but balance them with fundamental indicators like ore grades, CapEx plans, and mine permitting timelines. Education and patience are essential in this volatile niche. Looking ahead, Rare Earth Story points to a cycle where demand for magnets accelerates while supply grows slowly. The industry could see a relinking of Western refining with domestic mining, creating more resilient inventories and policy momentum. Prices will reflect not only ore quality and project progress, but also the credibility of strategic plans. For practitioners and researchers, the takeaway is to track CapEx, permitting, and offtake agreements rather than daily price ticks. If the trajectory holds, new projects may normalize volatility and unlock real value in diversified industrial portfolios. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.